Okay, picture this. You're watching the biggest stock market debut in human history. A genuinely staggering $1.77 trillion valuation is flashing across the screen. The Nasdaq is buzzing, the confetti is literally falling from the ceiling, and a company that routinely lands rockets like they're parallel parking has finally gone public. I mean, it's cinematic, right? It really feels like the future. But when the dust actually settles on that massive opening day, you have to ask yourself a very quiet but very dangerous question. Who is actually getting rich today?
Welcome to this explainer. Today, we're completely stripping away the hype to look at the cold, hard mechanics of Wall Street's most anticipated event. We're going to separate the incredible reality of those rockets from the highly engineered reality of the stock price. And, as you'll see, we're going to uncover exactly how the IPO machine is practically designed from the ground up to work against the average investor.
All right, let's start with Section 1, the Day 1 illusion.
Now, to be absolutely clear right out of the gate, SpaceX's engineering is breathtaking. What they do is a genuine marvel. But let's talk about Jerome. Jerome's your typical retail investor. On Friday morning, he opens his app, sees the stock climbing to $200 a share, and gets hit with massive FOMO. He taps buy, thinking, hey, I'm getting in early on the ground floor of the future. But here's the thing. Jerome isn't early. He's actually dead last in a highly choreographed Wall Street relay race. You see, hours before Jerome even unlocked his phone, the big banks and their best institutional clients already locked in their shares at the official IPO price of $135. So when the market officially opens, those institutions immediately start selling to excited retail buyers like Jerome at $160, $180, or even $200. That massive $17 billion first-day pop you see on the news, it's not proof the stock is a bargain. It's literally just the baton being passed, ending profit from latecomers directly to the insiders.
Which brings us to Section 2, the trillion-dollar math.
Let's step away from the loud, fast-paced hype of opening day for a second and just look under the hood, because the actual math tells a completely different story. At a $1.77 trillion valuation against $18.7 billion in sales, you are paying roughly 94 times revenue. And notice I said revenue, not profits. For some context here, the average company in the S&P 500 trades at about 3 times revenue. Even highly priced, hyped tech darlings like Palantir trade around 73 times. But here's the real kicker. Despite its massive revenue, SpaceX actually lost $4.9 billion in 2025. Think about that. You are paying a flawless, perfect future premium for a business that is currently bleeding cash.
And when we look a little closer at where that revenue actually comes from, well, it surprises a lot of people. The rockets, they're the flashy cinematic show that grabs all the headlines. But it's Starlink, the satellite internet service, that is actually paying the bills here. Starlink makes up 61% of the total revenue, and it is the only part of the company turning a meaningful operating profit. So when you buy SpaceX today, you're essentially buying one highly profitable internet provider that is basically subsidizing several massive cash-burning scientific endeavors.
Moving on to Section 3, Engineered Artificial Scarcity.
So if the price is that stretched and the business as a whole is losing money, why on earth does the stock skyrocket on day one? To answer that, we have to look at the absolute most important secret of the Wall Street IPO machine, the float. SpaceX only floated about 4% of their total company shares to the public on day one. The other 96%? That's locked up tight by early investors and employees. This creates pure engineered artificial scarcity. When you force massive global demand through a tiny 4% doorway, of course the price spikes. It's exactly like a VIP club intentionally only letting 3 people in just to make the line outside look incredibly exclusive.
And to make matters crazier, that artificial scarcity is turbocharged by forced buyers. Because SpaceX is so undeniably massive, it automatically gets added to major indexes like the Nasdaq 100. What does that mean? It means index funds inside millions of retirement accounts are legally required to buy the stock. They are completely blind to the price. They honestly don't care if it's trading at 94 times revenue. This massive wave of automatic buying props the price up even higher, completely masking what the true organic market demand actually is.
This sets up Section 4, the 90-day lockup trap.
You see, that scarcity we just talked about? It's strictly temporary, hidden deep inside the dry, boring prospectus paperwork. You know, the legal document that retail investors almost never read is a ticking time bomb. It's called the lockup period. Simply put, it's a legally mandated window where early insiders and venture funds are frozen. They literally cannot sell their shares. The entire day one scarcity is just a dam holding back a massive reservoir of stock. And the crucial thing you need to understand is that this dam is engineered to break on a very specific publicly published schedule.
Now, SpaceX didn't just use a standard lockup. They built a rolling staircase of supply. Check this out. Just 2 days after their first earnings report, which lands roughly around day 90, a massive 20% of eligible insider shares suddenly thaws out. Then, tranches of 7% continue unlocking through day 135. So right as the honeymoon phase ends, right as retail demand starts getting tired, a staggering wave of new supply is mathematically scheduled to flood the market.
And look, we don't have to guess what happens when this flood hits. History is pretty brutal here. Just look at Facebook back in 2012. Phenomenal company, right? But day one buyers watched their investment drop 50% when billions of locked shares finally came free. Or look at Rivian, which plummeted 67%. Being a great business does not let you bypass the basic laws of supply and demand. When massive supply meets ordinary reality, the retail investors who paid that scarcity premium are the ones left bleeding.
Let's pivot to Section 5, the Elon Musk signal.
If you still aren't fully convinced that this 90-day trap is real, you need to look at the most brilliant telling detail buried inside the SpaceX prospectus. And it has to do with the man at the very top. While ordinary insiders, early employees, and venture funds all fought for that staggered staircase so they could rush for the exit around day 90, Elon Musk put himself on a completely different timeline. He voluntarily locked up his massive 42% stake in the company for 366 days, a full, complete year.
You know, the actions of insiders always tell you way more than their words. Elon Musk knows precisely what happens to the stock price when those day 90 supply waves hit. By locking himself in for a full year, the absolute smartest, best-informed person in the entire building made completely sure he wasn't selling into the exact flood that the early insiders are about to create. He protected himself, while day one retail buyers got virtually no protection at all.
Oh, and it actually gets even worse for some folks. There's this whole shadow market of investors who thought they were being super clever by buying pre-IPO promises through complex investment pools called SPVs. A lot of these funds are stacked 4 or 5 deep, carrying brutal hidden fees and some pretty serious regulatory fraud risks. When those lockups open, these buyers are going to be racing the day one retail folks to the exact same exit door. It's going to create an unimaginably ugly traffic jam of supply.
Which leads us to our final takeaway in Section 6, the power of patience.
Okay, so we've seen the trap, we've analyzed the float, and we know about the lockup waves. So what's the antidote here? How do you invest in the future without just becoming exit liquidity for Wall Street? Honestly, it comes down to patience. You absolutely have to burn this concept into your mind. A great company and a great stock price are simply not the same thing. You are allowed to completely love SpaceX. You can believe they are going to colonize Mars, and you can still refuse to pay a mathematically insane price for the stock today. The company isn't going anywhere, but that engineered scarcity premium, that absolutely will.
Because think about it. If you buy at $1.77 trillion, ask yourself what the company literally has to achieve just to match the basic 10% annual return of a lazy index fund. To justify that valuation over the next decade, SpaceX would have to grow its revenue by an astounding 41% every single year, for 10 years straight without a single stumble. You aren't buying a business at that price, you are paying upfront for a flawless financial miracle.
So I'm going to leave you with this. The market rewards the patient far, far more reliably than it rewards the eager. The countdown clocks, the hype, the day one confetti, it is all explicitly designed to make you panic buy. But you don't have to play their game. Will you pay the day one tourist tax just to feel like you're part of the action? Or will you sit on your hands, wait for those lockups to expire, and let reality finally set the price? Let the confetti settle, guys. The rockets will still be there tomorrow.